Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. We have some economic news that came out this morning. The U.S. producer price index increased by a lot more than expected. We'll take a look at that. We'll take a look at the effect that it's having in gold, silver, and digital assets as we come back here in just a couple of seconds. We'll be right back. Prices paid to U.S. producers increased in August by more than forecast as persistent supply chain disruptions squeezed production costs this year. The producer price index for final demand increased 0.7% from the prior month and 8.3% from a year ago. A fresh, serious high labor department data showed Friday that excluding the volatile food and energy components and so-called core PPI advanced 0.6% and it was up 6.7% from August last year. The median forecast in a Bloomberg survey of economists called for a 0.6% month-over-month advance in both the overall PPI and the core figure. A variety of challenges across the producer pipeline, from material shortages and shipping bottlenecks and rising labor expenses, have driven up cost producers. Many companies have passed along those additional costs onto consumers through higher prices in recent months. Further stocking consumer inflation. The PPI report showed prices for goods increased 1% after a 0.6% gain in the prior month, while the cost of services rose 0.7%. Let's take a look at the markets right away and see how it's affecting here the gold and silver market. Gold is down about $3. 1796 is trading last, about down 360. Silver is trading at around 24.17. It's about unchanged roughly. So we've had a little bit of choppiness in the market so far. The reaction, as you can see, we appear to have stabbed into a major area of support. I want to bring up my Thinkorswim platform here. And what I have here basically is I have the weekly numbers on the right of the page, and on the left of the page I have the daily numbers, and I want to see the relationship between the weekly signals and the daily signals. Now, what we see is that the daily average is 1795, and that's pretty much the balance or equilibrium. And what we have seen here is the market on 9/8, about 9:45 p.m., came down to step into the weekly 1790 level and reverted from there as expected, but it could not get up to 1805 yet and reverted down below the average, and then it went to the extreme below the mean or the level of support, which is in that 1790 area to 1786 roughly. Now, trading below 1790 basically is extremely oversold on a weekly basis. And so what you saw here was a reversion after testing the low end of the weekly level of support, coming down to the daily level of support, and activating the buy trigger from that 1790 on the 9th of this month at about 6:45 a.m. And this is when usually the volume occurs where the retail business basically is pretty slow, and you get all this institutional accounts, commercial accounts, central bank pretty much selling the paper market to bring it down to what they, as far as they can push it, basically, until they come down to the market levels of support, and we begin to activate buy triggers based on the algorithm of the variable change in price momentum indicator. The algorithm basically trades the reversion to the mean principal. So as a trader, what I'm interested is in coming in, and we're looking at a day trade, and see the highest probability trades. Basically, if you're a day trader, or a swing trader. If you're a position trader, you're going to have a different dynamic in terms of the risk management for your portfolio. You want to make sure that when you design your portfolio, that you design it in a way that if you are trading for day trading, it doesn't affect your swing or even your position trading. And we'll get into, pretty much a little later on, how to create a trading plan, how to create a structure, how to create a day trading structure, a swing trading structure, and a position trading structure. We're looking at a day trading structure that has defined for us the average price basically of 1795, and the market trading above that average price has activated a bullish price momentum. A bullish price momentum. And that essentially means that you don't necessarily have to trade, because the AI tells you that when you are looking at the market around the average price, that it's pretty choppy, usually pretty choppy, as you can see here. So what we look for is the extreme above the mean and the extreme below the mean. The algorithm identifies the level of support in blue. So automatically you have a visual idea of where the market is in relation to the pivot points, in relation to the levels of support, resistance. And so automatically we look at it, it's in blue. Now the algorithm activates the buy trigger with very specific criteria that essentially tells you when the price closes above 1790 using the 15-minute bar. It activates a buy trigger as it did here. Automatically, your target is the level above. If you're doing multiple positions, you can use the levels above to execute the balance of your positions. So it activated a buy signal from this level, and automatically the target above was the 1810 target, if you're looking at the weekly signal. Now, if you activated a buy signal here, you can use the limits closer, the pivots, the closer pivots of the daily to unload if you're doing multiple positions. So if you did multiple positions, you got the signal along here, you unloaded some here, and you unloaded some up here at 1805 now, which was the target that we suggested in our live trading room, in our private trading room for the benefit of our subscribers and traders. We have taken some trades recently that have done nicely, basically. As you can see here, the last few days we've been buying it in that 1700 level or below, basically, where we've been getting the indicator to tell us in blue that we're getting a buy signal. So here we have the first target, 1793 completed, and then we produced the second target, and pretty much show the trade as we initiate the trade, and also show the trade when we get out of the trade. One of the things that I do here is pretty much execute the information, execute the signals live, and I'm coaching and teaching my traders here in this live trading room basically how to apply the GPS, the VCPMI as a GPS. So coming back here to the signal, there's no signal for today for day trading. The market trading above the average price is bullish price momentum, and it's already, as you can see here, from about 6 p.m. last night, activated the target of 1805, which was completed at 9:15. And it traded a few times, and it activated what it says here is a sell. Now, these are pivot points, and the algorithm activates them into a visual color, and it transforms the conventional pivot points into active probability indicators. And the algorithm, the AI, tells you that when you get up here, you liquidate, you make your target. When you meet your target, you go neutral. This is mean reversion trading, that you want to book profits, regardless of what happens to the market on the longer term or whatever the sentiment is. Again, we're looking at a day trading strategy, and it's a completely different strategy than any swing or position trading. So what we want to do is follow the little brick road, basically, in following the methodology that is applied using the VCPMI. Here it gave a short trigger, and it was around 10:45 p.m. Again, most of the activity that occurs in the market seems to happen overnight when there is no volume, when there is no retail volume. And of course, if you have the size and you have the muscle, so to speak, to see where stops are, you're going to be able to move the market towards that and begin a liquidation phase that brings the market down again to the average price, regardless of why the market came down. You see the synergy here tremendously correlated to this probability models. Now, what I'm teaching my traders is basically how to activate the trigger points. when to activate the trigger points, what the targets are, what your protective level is. And it's done in a very systematic way. Now, let's take a look and see where we are. In silver, silver is pretty flat here, around the 24.07 level, which, as you can see here, is the weekly level of support, the weekly buy one level, and you can see here basically the same relationship that unfolds in terms of the momentum of the market. This is a momentum, a probability model driven by a momentum indicator. And it's a combination of a complex number of indicators that we put together in a filter, basically, that provides a high probability model. In that, when the market comes down to these levels, what you see is a tremendous synergy. For example, in this case, it gave a buy signal. It didn't really quite meet the target, but if you use a trailing stop, you're going to be able to lock in some profits. In fact, some of my traders did that. And even though the market reverted yesterday and came down right into the average price daily and also the weekly buy one level, that already begins to identify the level in blue. And the level in blue is basically a level that tells you this is an area of accumulation of supply. This is an area where you can expect buyers to show up. And of course, that's what you see here. This is the confirmation. The signal activates not only a weekly buy trigger, but also a bullish price momentum because it closed above the daily average. And automatically, what is the target? The level above, 24.33. Completed at 9:30 p.m. When it got to the sell one level, the pattern shifted into a bearish mode. It completed the target and the market closing below now activated a short trigger, as you can see. So we book profits. We use the VCPMI to drive the trade to the target. We get out. If you want to take the risk, you can reverse, take the short. The target was completed. Reverted. Again. Didn't follow through, got a little more supply coming in, came right down again. Right into these numbers. And, you know, I've been doing this for many years, and I'm still dumbfounded by the fact that there was such an incredible synergy between the price and these momentum indicators. It's almost like it's an equilibrium level that, again, the market always looks for. And that's what's called the mean, that's what's called the average, that's what's called the equilibrium. So here's an example of how I use the daily, for example, indicators with the weekly indicators, and how it activates a trigger, a buy trigger. And so now it's on the long side. The target again is 24.33. Every time it activates a trigger above, it also activates the target above. And your protective level is either the average price or a close below the buy one level. The one thing I want to comment here is that when you see the price trading in the blue level, it begins to highlight the extreme below the mean. And the probability model, if we use the relative implied volatility, for example, the average price weekly is 50-50 standard deviation. When the price activates a signal from the buy one level, it's a 50-90% standard deviation, that the momentum will revert the price back to the mean. And in this case, the target is 24.51. Again, if you're doing multiples and you activated the weekly signal supported by the price momentum, you can begin to take profits earlier if you want to use the daily, which is 24.33. As the market reaches that level in red now, it begins to tell you the opposite of blue, which is the distribution of supply mathematically has a high probability to occur between 24.33 and 24.59. As you can see here already, it began to indicate that to be true. So, in terms of the targets above here, you have a short-term target at 24.33 to 24.59 using the daily. And in between, you have the weekly target of 24.51. So prepare for the market to revert into this area here, and then we can see the kind of buying strength that comes into the market that essentially will dictate the trading of the supply and demand that is identified with this algorithm. In red, it's distribution of supply. Potentially, this is where you could see supply come into the market. And depending upon the volume or the strength of the buyers underneath, it would determine basically the next higher fractal in price. And if we look at the weekly, it could go all the way up to 25.24, creating a weekly price, a weekly bullish price momentum. So the market will do what it's going to do, and the market pretty much will dictate, but you can see here that I have a very definite trading plan, depending on what the market does, and we don't have control of the market. The market will do what it's going to do, but it is a mathematical matrix. And the technicals of the market will always adhere to its supply and demand levels, to its average price. And the principle, basically, of the reversion to the mean principle is that it's a universal law that in the markets, particularly, as the market price, reaches the extreme of speculation, which is really what drives the market to those levels, that you can identify the supply and demand, the exchange, the kind of demand that comes into those levels, or supply that comes into those levels, in order to determine your trading strategy. So it's a very specific plan. It's a very specific structure. It gives you a prospective view of what potentially can happen based upon the market activating these levels. But mathematically, at least I know what to expect if and when the market reaches those levels. And we don't know really fundamentally what those levels are going to be. If we apply, for example, the fundamentals here right now, and we just take a look at the economic indicator that came out, I'm puzzled by the fact that gold is down and silver is down, as opposed to being explosive. We're looking at a higher level of inflation expected. And this inflation is not going away. It's not temporary. The sooner that you can begin to accept that, the sooner that you can begin to recalibrate and adjust. Because what we have coming here is wage price inflation. We have monetary inflation by the amount of stimulus that's been distributed in the marketplace. The market is flooded with money, and it's making the U.S. dollar weaker. It's making the U.S. dollar lose its purchasing power. We have price inflation because of the supply bottleneck that we have, the supply problems. And now, we are getting into wage inflation, which in all three cylinders, we're going to see an acceleration of inflation that we haven't seen before. And we have yet to deal with the availability of supply, with commodities, harvesting, and we, don't know yet what the total grain production is going to be now after the pandemic and so on and so forth. We can speculate, and you can look at all of the propaganda that's in the internet and so on, but it's very difficult to dissect fundamentally the reality of what is going on, particularly when you hear that China is creating propaganda over 40 different websites, and it's really difficult to distinguish what's true or what is fake in using this technology at this point. Coming back to, for me as an individual trader, how do I take advantage of this for myself? I used the VCPMI, which is why I created it. I couldn't find anything else out there that would give me the combination of WD Gann, Elliott Wave, Fibonacci, vortex mathematics, directional movements, pivot points, moving averages, and so on. I had to look at all these different indicators individually, and it created a real confusion for me because some, 30% were long, 60% were, short, and the other 10% was neutral, and so it didn't give me quite the confidence level to use it until I decided that, basically to create the variable change in price momentum indicator, which is a combination of all of them, into a very simple format that you can see here, which is a very specific structure that it gives you as a trader for day trading, for swing trading, and for position trading. So, coming back here to the gold, I would stay long. You're getting a price momentum moving, and I don't necessarily like to trade actively, because the more you trade, the more risk you take. So as a trader, basically what I look for is the highest probability trades. And what I want to do is either wait for the market to go up to 1805. I am long the market. I have long positions. And, I'll see what happens up here and what the market does, and see if I want to take some profits here or not. But this is the target for the price momentum that has unfolded, basically, from the average price of 1795. And we have activated a buy trigger from the weekly average of 1790. That's as clear as I can make it for you in terms of how I personally apply this strategy. So continue to hold on to your derivative longs. If you have long positions, hold on to them. I think the market is in an area where we call the extreme below the mean, or using technical analysis, it's pretty much at an extremely oversold condition. We want to see the market come back out to the yearly average price of 1810, and that is the weekly target that you see there of 1810, and that's where the harmonic alignment comes in. If we do close above 1810, it activates the upper end of the annual target again, which is 2150. So be patient, hold on to your longs, and have a great weekend. I look forward to seeing you on Monday. Be well. Take care.